Hey guys, Simon from Swing Trading Lab here. What I want to do today is cover a intro to swing trading and really just upskill any beginners that are looking to either accelerate their training when it comes to swing trading or just get started in the markets. Maybe you have absolutely no experience. This is a good place to start. And we're going to cover some sort of core uh, elements, some core frameworks that can really help you with your swing trading. So to get started, why do we get into trading? I will just start writing some stuff. I think it's for time. We want more time. We want more financial freedom. We want more control over our lives. So we get into trading for these things, really: more time, more financial independence, so maybe away from a job or something like that, more control. But what happens if you don't really know what you're doing in the markets, or maybe you're spending too much time on these really low time frames? Is the inverse happens. You actually lose time because you're glued to TradingView. You're spending way too much time on the charts. That has a detrimental impact on your financial control, because you start pouring money into the markets. Maybe you're losing, you're not profitable, and things can spiral quite quickly, and suddenly you feel like I've got less time and actually less money, or I'm draining money. And then thirdly, that obviously means that you have no control, and that can lead to really bad habits in the markets. And so the point of swing trading really is to give you back that time, that control, and then hopefully give you the framework to start actually making money from the markets. So that's really what we're going to cover today. What is swing trading? So what is swing trading? I just want to make this a little bit bigger. Swing trading essentially is trading the higher time frames. Price is ultimately fractal, so everything that you see, even down to sort of arguably below the 15 minutes, it does get a bit more choppy. But as long as you're using the right frameworks in the right context, you can really apply this across any time frame. So when thinking about swing trading, you can swing any time frame. But when we're talking about swing trading, we're really talking about utilizing higher time frames. Because what we don't want to do is be sitting on these lower time frames all day. Sometimes you can get in and out of the markets quite quickly, and that's great. But if you're looking to come to the markets at certain times in the day to give you back that control, maybe your setup isn't there, you start forcing trades, and that's not behavior that we really want to see. So swing trading, as I'm going to define it, is basically taking price from certain points in the market. So this is the 1st of September to other points in the market via swing positions. So it would be looking on the lower time frames to take that swing position from the 1st of September or somewhere in this mid candle to the end of September in this case. So maybe these trades play out over days or weeks, or even sometimes most of a month. But ultimately what it's about is giving you a very structured way of approaching the markets, giving you discipline and control, so that you can come and use trading and utilize trading alongside your day, but actually still have a very solid way of monetizing the markets that is equally as profitable, if you're good at it, than using these lower time frames. So that's what we mean by swing trading. Now, what we need to effectively swing trade is a framework. So the framework that we're going to talk about today is actually, first and foremost, we need a bias. So we need to know whether price is in a bullish trend, a bearish trend. What is the objective of price at any given time in the market when you're coming into the market? So first and most important thing here is bias. If we can nail bias, then we can get a lot wrong and still be profitable. The second thing is MTF, multi-timeframe analysis. So multi-timeframe analysis is a very basic concept. It is understanding your bias on a higher time frame and then using lower time frame execution to see what's actually going on within these candles. So this is a 2-week chart. So this is 2 weeks of price action in every single one of these bars. So with multi-time frame analysis, we can actually drop into these bars and understand what's the trend in here, where can we take entries to target higher or lower positions in the market. And then finally, we need an execution framework. So entries. When is it that we want to enter and exit trades? What do we need to see to actually get into a trade, to feel like we're confident that we can take a position in the market? So that's our framework. If we just start with bias, what I use for bias is a concept called CRT, which is candle range theory. And what this basically means is that every single candle is its own range. So if you are looking at a specific area of price, take this candle. So I'll just actually pull it across. So this area of price that traded within the month of September, we can draw a lot of conclusions from how this candle closed to determine what we think is going to happen in the next candle. So for example, we can see that this was a bearish candle, and if we take the level of the previous candle, it closed below that candle's low. So what we would expect to see is that price would continue to travel lower because it has not raided any liquidity below this low in order to maybe target higher. It's closed below this low, which tends to indicate that we're still seeking liquidity lower. The whole point of CRT or candle range theory is that if you take this candle or this candle as its own piece of price, this candle is a range. So the range can either be broken out of, which in this candle it is, and it can either close below the candle's low, meaning that we're probably going to anticipate further aggression in that direction of price, or it can sweep the candle and close inside that candle's range, which is what happens with this candle. So you can see price traded lower and then it closed inside this candle, its previous candle's range. So we can very easily mark that on our chart. So in this case, we're on the 2-week time frame. So what I've just done there is mark 2-week turtle soup, 2-week TS. And a turtle soup is essentially a raid of this candle's low and a closure inside this candle's range. So the whole premise of CRT is that if we get a close inside a previous candle's range, there is reason to believe that we would want to target the opposing end of that candle. So if we call this a CRT low, I call it turtle soup or range low, whatever, it doesn't really matter. And then what we would do is then say, okay, well, we've closed inside this candle's range. So now price either wants to target the midpoint of this candle, which would be the 50%, or it wants to continue until the previous candle's high in order to purge the liquidity at the top of this candle. So we can call this CRT high. And actually, if we just use bar replay, this would be what you'd be looking at in the market at this particular point if you were to be doing this without the benefit of hindsight. So as soon as we get this candle closure, we can see we've swept this liquidity, all these lows, we've cleared them out, and we've got this high here that price might want to trade back to. So what the framework that I use is called as CRT. We're going to go into this in a lot more detail, but essentially I'm looking for higher time frame CRTs that we can look to then exploit on the lower time frames using a very structured model. So once we have our bias, in this case, we're looking at a bullish bias because of the reasons I've explained. Purge the liquidity below this candle's low. We now want to target this candle's high. If we were looking at this particular candle and we saw it close like that, then actually in this candle, I would be looking for continuations. because we have not yet had any reason to believe the price is going to reverse, because this candle has yet to be swept. One just point to mention here is that we don't always need that, because we can be looking at even higher time frame CRTs. But in this case, we're just going to keep it simple and stick on the 2 week. So bias we now have. So now we need MTF, multi-timeframe analysis. So there are different time frame combinations that you can use for this. What I've found to be very effective is when I'm trading weekly, 2 weekly, monthly, I will stick on 4 hour upwards, but I will do a lot of my execution on the 12-hour time frame. I just like it. And actually, if you have a good bias on the 12-hour time frame, then you can get tighter executions on the 4 and 6 hour time frame by having a strong idea of what's going on the 12-hour. In addition, if we go back to what we were talking about, why get into trading, it's to give you back control and time. If you're using the 12-hour time frame, every single bar of price closes, in 12 hours, 10 a.m. GMT and 10 p.m. GMT. And a lot of the pairs that we will trade, so anything that is, Euro, CHF, USD, a lot of the action happens in the London and New York sessions. So actually, like, the real core close that you're looking at is 10 a.m. 12-hour candle. So straight away, if you're just thinking, okay, I want to get into trading, but I don't have too much time, or I want to be very systematic with it, you only need to look at the markets at 10 a.m. or around 10 a.m. every single day, which is right now. If you can see, it's 10 a.m. Make your judgment, come into the market, run your analysis. This doesn't have to take long, especially if you're on top of your charts. Make a decision. Is there a trade? Yes. Is there a trade? No. And then get on with your day. So that is the real beauty of swing trading, especially using the 12-hour. Now, if you want to then refine further, the 6 hour then closes at 4 a.m., 10 a.m., in coinciding with the 12-hour close, 4 p.m., and then 10 p.m. The 4 hour, you'll get even smaller increments, 6 a.m., 10 a.m., 2 p.m. But essentially what you can then do is structure your life around those specific windows. So if you just want to look at the 12-hour, you only need to really care about 10 a.m. and potentially having a look at the markets at close at 10 p.m. If you want to look at the 6 hour, then you can look at maybe as the market's open around 6, what happened at that 4 hour close, come into the market again at 10, then maybe check at 4. You might get entries in that afternoon slot or the New York session. But again, a lot of your execution will probably happen in the morning anyway. So again, think about timeframes, think about what's going to make you comfortable. For me, I run analysis across every single Forex pair, so 32 pairs, which means I prefer to spend time on analysis and then limit my execution to maybe around 10 a.m. Maybe either side of 10 a.m. if I'm really getting a strong view of the markets, but really I have control to come in when I want to come in a structured way, rather than having to sort of feel like I'm always FOMOing or missing out, or something's happening and I'm not there. So that's multi-time frame analysis. If I just drop to the 12-hour, we can start getting into this. I've lost my box. I'll just recreate it here. So we're looking at multi-time frame analysis. So now what we're doing is looking within the candles that we were previously analyzing. So you can see here I have this specific indicator on my chart, which is very, very simple. All it does is gives me a view of the higher time frame candle, but behind the lower time frame price action. So in this particular case, I'm just going to take off the weekly. We have you can just see these 2 week candles. You've got the candle high, candle low, candle high, candle low. So you can see price traded down. I'm just going to make this very, very straightforward. If we just bring a path. So in this particular 2 week candle, price traded up. We had this sort of fractal shift, down, up, again, little shift, down. There was a shift here, and then price change structure, and then currently we are bullish. So you can see there's a picture of the market right now. So we have made an assumption on the higher time frame. The price is going to sweep this 2-week candle's low and target its high. Again, there's more that comes into this because now we're looking at a range on a lower time frame. But essentially, what I would like to see here is that this particular range, let me just bring this up so it's very easy to see. This particular area of price action is respected. So we will see a retracement into this area, and then we'll see price go on to take the high, the area of the CRT high that we previously marked. And if you think about this logically, you can actually see if price, as price makes its way down here, let's call this one expansion back. If price wanted to go lower, we can see that it did start to go lower, and actually we had this area of demand here, we had this area of supply here, this area of supply here. So for price to trade lower, I'd really wanted to see a retracement into this area, and then price to do that, to start to respect the supply in this area, and then trade back down to the monthly, the 2-weekly low at this point. That didn't happen. We just got this trade straight through. So a disrespect of this area. So now, as I say, we're now looking for this to happen. Again, it's very logical, structured price action, really. But there is a lot of intricacy that we can get into, looking at things like order flow, structure within this specific leg, price leg. But it is a basic concept. That's what we're looking at. Okay, so that's multi-time frame analysis. It's just a very simple concept of using lower time frames to execute higher time frame ideas. So now we need execution. So there are various places that you can execute from within. It could be basically internal points of liquidity. I call it internal liquidity here. But we have things like fair value gaps. We have order blocks, breaker blocks, fair value areas, swing points, even fib levels, which I don't use too often, to be honest, but this now comes down to really personal preference and how much you want to just sit back in the market. Because what we can do, and I'm just going to, again, given this is a beginner's lesson, mark out very clearly here what we're looking at. So you can see this is the entire candle's range for candle 1, the candle that expanded below that candle's low. I'm just going to mark it in light gray here. And then we had this specific candle here to that high, which is just closed. And you can see that clearly traded lower, structure shift, liquidation of the low. Now, we are now looking at this particular area here for our expansion. So if I just quickly talk about each of these things, in terms of just pure fib levels, so what you could do if you wanted to be not lazy, but just, you were confident, you wanted to really sort of sit back in the markets, you can just mark the high of this area and the low of this area. And you can see that's the midpoint of this candle's range, or this, sorry, not candle, the midpoint of the range, essentially. So you could just set a long entry at the 50%. Now, again, this is a beginner's session, but you can look at within ranges, premium and discount areas. So if you think about it, if this is where price is trading, this is the fair area of value for price. If you are buying above this 0.5%, you're in the more expensive part of the range. If you're buying in the lower part of this range, then you're buying more cheaply. It's the discounted part of the range. So if you wanted to just be very systematic with it. You could say, okay, I want to buy at the discount, the entry of the discount, and I am going to put my stop below the low. And what we are going to do is use the high that we've already marked as our target. So there you can see, by doing this, you are executing a trade with a 2R potential. So you're swinging from this point to gain 2R in the market. So that is idea one. The second idea is that we have what we call fair value gaps within this specific leg. So there's actually one there and there's one there. So a fair value gap, if we just zoom in, is essentially where there is a gap in price between two candles. So you have candle one, expansion candle, candle two, leaving an imbalance in price that often gets filled before there is an extension in the same direction. And you can read into a lot using things like candle science to see what happens around these fair value gaps. Are they respected or disrespected? So straight away you can see this 12-hour candle is closed inside this fair value gap, which to me would say, okay, it's disrespecting this area. So it actually probably wants to trade lower. So if you're thinking about executing in the market, you probably wouldn't want to execute here because at the moment we're disrespecting this fair value gap. That's a concept that we can get into later. So actually it might want to trade down to this fair value gap or just the discount of the range. However, before actually I move on, you could, if you wanted to be, again, you wanted to take a position trade maybe, you want to buy from a period of internal liquidity and you're happy to just target a 1-to-1. You can just get in here, you're happy to sort of sit in some drawdown, but ultimately you're confident that your higher time execution will lead you to profit. Just going to clear these off. Now, if you see any of my charts on X or YouTube, you'll see that I mark everything up across all time frames, and it can sometimes look a little bit messy, but once you get used to it, it's very simple. So I'm just going to mark here order blocks using the 12-hour. So you can see here what I'm doing is just I'm marking 12-hour order block, and I'm just going to mark them all up so that you can see this very clearly. So price comes up here, new order block is created, it doesn't get tagged. Now an order block is where you get, in this case, you get a buy pressure, which is traded through, so it's almost like an engulfing candle here, where you then get an area of price where orders have been created, then an expansion in the opposing direction. So in this case, the order block is right here. You've got a fair value gap, price tries to expand, comes lower, leaves a new order block, and actually, because we have that bias, we can use that to target lower. When we come down here, you can see there's this big sell pressure, and then price trades above. So it engulfs this candle, creating a 12-hour demand zone, an order block that we can use to target higher. Then price trades, creates this range, retraces into this order block and expands again, and then we create a new order block. So it's this last piece of sell pressure, this last sell candle before we expand. Now on a higher time frame, this whole area from the high of this sell pressure to the low will be an order block on a higher time frame, but we're just going to stick to the 12-hour right now. So we've talked about fib level, we've talked about fair value gaps, now we're looking at the order block. So you could again now just say, okay, well, I only want to trade from order blocks. So I'm going to put this position into the market and I'm going to target a nearly 6R. But what you're then relying on is for price to trade all the way down to the order block and then expand. It can happen, it does happen, but we can also find internal range liquidity here and expand, and you might get missed and you don't profit at all from the trade. That's fine, but obviously if you're executing on the 12-hour, sometimes that can be frustrating because you do all this work, you're extremely patient, then you don't get tagged in. Then we have breaker blocks. So if we're looking at, sorry, this was an order block got formed right here. This then becomes the breaker block in this case. So it's this last piece of buy, this buy pressure before there was a sell-off. So that would be your order block, which is containing price to go lower, which gets disrespected. So if I just mark this here, and I'll just mark it as a 12-hour breaker, you can see it very clearly. So price could come down and just bounce off of this level, this old order block that was disrespected, and then trade higher. So again, you could take an entry which is similar to the fib entry from the breaker block, which would be a 1.82 with the stop below that low, or you could just cover the block itself. But then you need to be conscious that there's a fair value gap below here, there's an order block below here, which might get stung into, which would stop you out. But these often do also play out. Fair value areas are not something we're going to touch on too deeply here, but this entire area would be your fair value area. It's almost like aligned with the discount point. And then your swing points would be your swings, your high and your low. So sometimes price will trade all the way back down to the swing low, and it will look as though we're going lower, but it will actually just constantly respect this level and then target higher. But at this point, I would not look to be taking a trade from the swing low, because there's no justification for it right now. But if price did start to disrespect this area and we were trading down, and then we got a new structure shift, that might be something that I would look to do. But for now, it's not. Okay, so we have candle 1, candle 2, we have our target, we have the sweep, we have a structure shift, and we have our range fully marked out, although I've taken away the fair value gaps. So you have multiple choices here. What we're going to do, just for ease, is say we're going to take a trade from the 0.5% here. We're going to cover the low, and we're going to take a 2R to the high. So that's our trade. So now we can just wait and see what happens. So price comes down. Okay, so we were correct in saying that there was disrespect of this fair value gap, and we are now tagged into the trade. Price has mitigated the discount of this range. We get an up candle. Okay, now we have a sweep of these lows, another sweep, and actually the order block is now tagged. So if you had have got in at, and you would have marked the order block entry, you're now in this particular trade. And by the way, if you are taking these sort of sniper entries, you don't have to hold to the highs. You could just hold to this this midterm high. You still get a 3R. Or even if you have a fixed target, you could trade a 2R or maybe a 3R here, and you're not taking the full swing, but you're just sniping in and out. But for us swing traders, we just want to hold through these volatile price areas and just really maximize the entire swing, and do it in almost like a low stress way, where all we have done is come into the market and very systematically monitored to see, has there been any shift, what's happening, we're in the trade, and now we just wait. So now we get this shift, and this is interesting now. So we're in profit on the trade, but what you can see is we're still using our multi-timeframe analysis, and we're still marking this up. So we come into the market at 10 a.m. and we can see there has been a new order block created. And I'm just going to mark this to make it very easy to see. So we have 12-hour demand right here. So you can see this is a sell pressure, tags the order block, shift, and engulfs this candle, creating a new order block. So if you wanted to actually wait and see, okay, where's my shift within this area? So you're not interested in just blindly buying in this range. You want to actually see a shift in here. Now is your chance to get involved. So you could set a new order covering the new order block exactly the same target, and now you have a 2.52 risk to reward. If we just see, yep, okay, we're tagged in. If I remember rightly, the price action here is quite choppy, which can be frustrating. But you can see we've now had an expansion away from that area. But I think, if I remember rightly, because I actually took this trade, this was where I started to fear a reversal. Yeah, so we get this close here. But you can see, and this was what I saw in the market, if we just take this specific level as our guide or our gauge here, we don't ever see a structure shift. We don't ever see a new bearish order block, because what we want to see is that price traded through, close below this specific candle to then use it to go lower. But that didn't happen. It just swept that low. So even though you're in drawdown here, it feels uncomfortable, nothing has actually changed. And if you wanted to look at this, you actually have a new 12-hour order block here as well. But yeah, I mean, if you would have got involved off that order block, that could have potentially been a loss. But if that was me right here, I would be using this entire area still. So let's go forward. Okay, now we get a bigger expansion here, and you get a new order block again. So if I just delete that one there, so you've got, let me just show you this. We have order block at the base of the range, new order block formed, and now we're starting to see demand really in control. And I just mark that to make it again quite obvious. So what we're expecting now is that price respects this to go higher. Now, if you wanted to layer into this again, you could probably put another entry on here to target a 3.96. So this would be layering in, pyramiding into the trade. A lot of the time, I will just stick in my position. I'm happy with my initial position. But, you know, if you're very confident on that swing point, this is something you could do. So you could be now in a 2-hour trade, a 2.5-hour trade, and now you're putting more risk in to get a nearly 4-hour trade. So let's see what happens. Do we get stopped out? Still in the trade, just. So that's why you should always just add a little bit of give in your trades. But the purpose of this candle, honestly, is to scare you out at this point. This is what you see very often, is that right before the big move, you get these very bearish or bullish candles against your trade. And you would have now means to say, okay, well, we do have an order block in the opposing direction. So maybe I'm wrong. However, if you now look at this again, like, what are we reacting from? We haven't taken this high. This is probably just like a daily trade or a 2-day trade where it's seeking liquidity before a move. Because if you look at the higher time frames, nothing really has changed. Let's play it forward. Okay. Then we get a move out. So if you're in this, you survived, you're now back in profit. You're back in profit on all of these different positions. And then we really do get the acceleration there. And then you get a new 12-hour order block. Let's see if there would be a tag off of this. You know, you can still look for a 1.6R risk to reward trade if there's a tag here. I don't think that tagged. No, it didn't. Left a small fair value gap here. I think I tried to get involved there, but no opportunity. And then, so price is very aggressive. You see this very bearish candle, and then price gets very aggressive. But if we just reverse this out, this was a no tag. This, we just survived. But if you did have your stop at the order block, you would have just got stopped out. which would have been frustrating. But if we take the safer trades earlier in this price action, you can see quite a comfortable 2R. We did have to sort of run through some drawdown, but not too bad. And then a really nice 2.52R as well trade there. If I just take them off, we can then see what has candle 3 done. It's not closed yet, but it's expanded to the high. So on the higher time frame, you can see candle 1, liquidation, target the opposing end of the range. And we've been able to see, we've determined our bias on the 2-week time frame. We've waited patiently to see a clear liquidation of candle 1 and a close inside its range. We've seen a structure shift. We've then marked out our range, and we've found our execution points. And then we have fairly systematically entered into a position with a clear target to double or almost triple our money. And if you were in a position from the order block, which a lot of people choose to do, that is an exceptional trade. It's a 6R trade. So you would have got stung. You know, it's about really being disciplined and being patient in the market. You get stung in, taken into the trade, and then you're just riding out that entire swing back to the upside. So that is swing trading. There's a lot that goes into this because it sounds very simple and easy when you see it play out perfectly. But there's also a lot that can happen and go wrong, and you see changes in structure where you don't expect to, and you can start to get caught out. So my advice is to take maybe 5-10 pairs, look at say 6 months of price action, and mark weekly, 2-weekly, monthly CRTs, and see on what lower time frames did you see these shifts, these ranges of price get respected, and start to actually play around with this so that you can find your own way of coming into the market, having a very systematic framework that you can use to identify a bias using multi-time frame analysis, mark key areas, key levels in those different ranges, key targets, and then points that you want to execute from, and start to think about a trading plan. I obviously have my own. It's very much built around higher time frame CRTs with 12-hour execution. Every single day, every day, I'm in the market marking out these key levels, looking for reactions from primarily breaker blocks, order blocks. I just mark that for my OCD. Breaker blocks, fair value gaps, to see these CRTs complete, or at least trade back to the 50% of the range so that I can take advantage. I've run a free Discord as well, so you're welcome to come in and check out that Discord. Definitely subscribe, because I'm going to put a lot more content about swing trading onto YouTube over the coming weeks and months. And I'll do a whole video on common mistakes. And something that really, really caught me out early in my trading is that you can have this perfect setup, but then what happens is that here, when you get this this move, and you're very bullish on something playing out, you get a sweep of this this middle candle, and then you get a shift, and actually you get an opposing CRT at that point, and you're stuck, you're glued to this bias, and then you end up just taking a loss and actually missing the true move in the market, the true swing move. So I have techniques and ways that I can spot that. But this has been actually a longer video than I thought it was going to be, but hopefully a very informative look at the beginning and the framework for effective swing trading, especially in Forex markets. So please subscribe to the video, and I'll see you on the next one.